Hello and welcome to the Mutual Fund Show. I'm Niraj Shah. For the next 20 minutes, we'll talk about a few key aspects around mutual funds. There is a new regulation which we'll talk towards the end of the show around nomination and what it means. I mean, are we really going backwards? But before that, the key aspect that I think a lot of you have asked about behavioral patterns when it comes to mutual fund investing. And therefore, we thought we'll ask both our experts today that what are the top two or top three triggers for them, either on the upside or on the downside of their choice, when it comes to taking a decision on whether to invest in a mutual fund scheme or whether to opt out of that SIP or lump sum that they may already be having. So that's with that idea, let me welcome in Prableen Bajpai and Mohit on the show. Thank you both of you for joining in today.
Thank you, Niraj.
Yeah. I was just about to say, thank you, gentlemen, for joining in. And then just realize, hey, we have Prableen on the show. So Prableen, let's start off with you. What are you sharing with us 2, 3, or 4 key triggers, Prableen?
Yeah.
Okay, let's start with one. And then we'll kind of do it on a piecemeal basis. One key trigger. Is this a positive or a negative?
Okay, so should I do it category-wise? I mean, equity or debt? So
okay, let's start that way. Yes, let's start with equity then.
Equities. Okay. So triggers or red flags, basically, Niraj, are I think slightly stronger words. I would say that these should be filters, or then these schemes can probably put in the watch list for investors when they see these changes. I think the first one will be a fundamental change in the scheme's objective or structure. And this is usually due to some regulatory change, which has been introduced by the regulator, by SEBI, and because of which the scheme has to undergo some structural change. So investors, I think, at such points have to just check whether the scheme is, the same as it was after the structural change in terms of suitability. Will it serve the purpose for which it was originally, taken in the portfolio? So I think that's the first one here. The second one for me, I think, is very important, which is the key man or the organizational hierarchy of a particular fund house and where the schemes, where one is investing. And I think this is not only true for AMC, this is also very important even if you have other investment options, be it PMS, and even for the firm through which probably you are investing. So in passives, this doesn't really matter. But I think with a lot of newer AMCs coming and newer AMCs or older AMCs coming into limelight at times because of exceptional performance, Niraj, I think it becomes important for investors not just to go and pick a scheme. I would say, are they able to name 2 or 3 key people from that AMC? That is very important. That's a question that they need to ask themselves. Who's responsible for the overall management? How strong is the hierarchy in the organization? And is it a process which is there? We've just seen the case of HDFC. It's a very big organization. So there's, SOPs and a lot of other, standard procedures which are there. But how about a smaller AMC where one person is the main person who's running the show? So, and key man risk is not only for AMCs, it's also seen in companies. And that is why there's actually an insurance which is called the key man insurance to even insulate businesses. So that's the second one. And third, I would say is the performance of this scheme. Underperformance over 7 to 8 quarters as compared to the peers as well as compared to the benchmark. And I think a good measure in terms of active mutual funds should be the information ratio, because your information ratio measures how much it's sort of a measure of the fund manager's performance, because it is giving you risk adjusted returns, not over and above a risk free asset, but over and above the benchmark. So I think that one becomes very crucial again. And one more I want to highlight is from a investors' portfolio point of view, I think there should be a trigger for them, or caution should come in place if they see that the markets are in euphoria and their tenure, the goal tenure is very little, which is left, let's say 1 to 2 years. And here I'll quote the story of Joe Kennedy in 1929, what is commonly used as the shoe shine boy, what came to be known as the shoe shine boy story, where his shoe shine boy actually suggested Kennedy some investment tips. And that was a sign that, the markets are in euphoria. It's probably the end of the bull cycle. So I think that is a very crucial time for investors whose investment tenure is now barely, 2 years away. I think they should exit from equity and gradually consolidate the returns that they have made. So broadly, these are the ones. And of course, too much allocation to a particular fund house should not be there for an investor. So that's something, again, they should check. Not more than 1/5, I think, in any particular AMC.
There is one more Prableen out there. 1999, Chaurasya Panwala told Niraj Shah about a stock tip, and that kind of marked the top of. I think it's used in India that way, right? When the neighbor and the aunt and everybody else starts
Yes,
talking
everybody's talking about it. Absolutely.
Yeah, but interesting. Thanks for sharing these, Prableen. Mohit, to your mind, and if we can kind of do the categorization that way, unless you have a separate way, but let's think about equities first. And what are the key triggers or the red flags that you use before deciding for and against investing in a fund?
Sure. Hi, Niraj. Honestly, it's very difficult to now top up on few points. I think whatever Prableen has covered is a fairly comprehensive list of triggers. If I were to add a few more, which we personally look at or observe quite closely, I think the first one to my mind is if we see a change in the market cap allocation of the scheme. And that's actually very true with the flexible kind of schemes, like your multi caps, your flexi caps, your value funds, your ELSs, and all those kind of schemes, which are blended schemes, right? So, what kind of a composition has typically the fund been following, which is how much in large cap, how much in mid, and how much in small, becomes extremely pertinent with respect to the risk profile of the investor and with the kind of risk he wants to undertake with the fund, right? And if you see a dramatic change in the philosophy, let's say if a particular fund has been running a large cap dominant strategy with a very minuscule composition to small and let's say around 10-15 in mid or around 20% in mid, and you want that kind of a profile of fund, but suddenly if there is a dramatic change and the increment in small cap is fairly high or mid and small suddenly overpowers the large cap allocation, then you need to know or have a discussion with the client basically whether it's the right time to exit the call, because that was not the objective with which you entered into the scheme, or that was not the risk mind frame at that point in time. So that the composition of the market cap, to my mind, is a very, very critical factor. The second part, I think, which probably touched upon in terms of key personnel, but to my mind, a more narrowed down focus approach on the fund manager himself. Look, to me, the money investors is as good as with whom it is invested, right? It's not about, it is obviously the broader framework of the fund house and the philosophy, so on and so forth, and processes and everything. But the man who's managing the money finally is the one who's responsible for giving you returns. And if I was comfortable with Prashant Jain for whatever 20 years of my life, and if there is a sudden change now and there's a new guy at the helm of affairs, I might not want to continue with him. To me, my investment was more safe and secured, whatever be the cycles of returns, but I was more aligned with the Prashant Jain philosophy, then I would want to continue with that kind of a philosophy, right? And so you also need to know who's managing your funds. Too many changes of fund managers at a particular scheme, to me, is a very, very big red flag, right? You can't have schemes changing hands every now and then, and a new fund manager.
Has that happened in some of the larger schemes, Mohit, or is it probably something that's happening at some of the smaller houses? Too many changes.
Look, smaller houses, definitely the fund managers keep moving up. They try and pick up the ladder and move to newer fund houses. So at smaller fund houses, you will see these changes a lot, basically. But even in mid-sized fund houses, I've often observed the smaller schemes, not the flagship ones. In the smaller schemes, there are shuffles around fund managers. There are co-fund managers being added. There's a third fund manager being added and the first one being taken out. So all those kind of shuffles, yes, they're fairly frequent these days in the industry because the number of schemes are increasing, new NFOs and the fund houses and so on and so forth, right? So that's the second one. Underperformance, I think Prableen has already touched upon. And one more point which I would perhaps want to add is the change in investing style. right? There could be a fund manager, again, it's related to the personnel himself, who was kind of avoiding cyclicals or real estate and commodities and infra per se as an investment philosophy. But suddenly you see, because of a particular market cycle or a particular news event or a particular budget, you start seeing the fund house loading up on infra stocks or real estate stocks. Then perhaps you just want to cut out from that, because that was not the objective or that was not the philosophy with which you aligned with at the first place, right? So those are few key trigger points, and all of these are much more nuanced in terms of doing a deep dive on the underlying stocks and the composition of the schemes per se. And I think that's where the investors will have to go down, because finally, if you really want to align your portfolios with the new market realities, you will have to go down under and see how things are shaping up below the carpet.
Well, interesting, and some key points to watch out for. Thanks for that, Mohit. Now, before I start the debt piece with you, Mohit, probably just one quick a follow-up to a point that Mohit made, and which was around the flexi cap, multi cap funds, and the market cap allocations thereof, and the changes done. When I looked at the flexi cap portfolios of a bunch of fund houses, right, and if I take the aggregate, they resemble a large cap fund a lot more than a truly flexi cap fund, right? So in that sense, is that a sign for or against choosing a flexi cap category, or is it okay because it's the sign of the times that currently large caps may be more stable, so some of them are choosing that? What's your sense?
I think, Niraj, yes, like you mentioned, flexi cap is, let's say, smaller cousin, younger cousin of the large cap category only. In large caps, we have a 80% mandatory allocation to large caps, and we have a 20% leeway. And if you look at the flexi cap portfolios, I think the minimal that they're holding in large caps is around 50, and it actually goes as high as 85% in large caps. So essentially, the bigger, the AUMs, they are gravitating towards having a more large cap oriented portfolio. So I think flexi caps in the current format, see, because this is something very hard to say, because you have the flexibility, it's totally legitimate on the part of the AMC to actually keep shuffling, right? So I think, let's say if I am going in for a portfolio where I'm thinking that, I need a large cap. So I think instead of an active large cap fund, maybe flexi cap can be actually added. That's a good way to do it. And second is that flexi cap, I think, is a good addition to a core passive strategy, I personally feel. So if I have to create a portfolio for somebody where I have given him in a large cap passive strategy and a mid cap passive, Niraj, then I think a flexi cap is not a bad addition, because you get allocation to large caps, mid caps, other segments as well. And those segments may actually be missed out by the index itself. So that way it can be a decent fit. So I think its usage actually depends on how the portfolio and for whom it is being constructed.
Okay. Mohit, you want to add something to this, or else we can start the debt piece, but you want to add something to this?
I think that's a very valid point which Prableen made. Basically, I think flexi cap is the new replacement of the large cap in any portfolio today in today's context, because typically more and more portfolios are now getting aligned towards the passive strategy on the pure large cap side. So it's better that if you really want to play active out there, you go with flexi cap. I'll just take a very small example, Niraj. It's a stated philosophy for a Kotak flexi cap fund, which is perhaps one of the largest out there at around 39,000 odd crore AUM, that they will steer it predominantly towards large caps. So they'll keep almost like 70+% large caps in the portfolio. And when you know that that's the stated philosophy, and you get into the fund with that philosophy, then you know that you are replicating and kind of an active large cap in your portfolio. But a sudden change there could disrupt the philosophy with which you enter, and that you have to keep in mind. But otherwise, I think yes, that's the way to look at flexi caps now.
Yeah, viewers. So if you want, probably please make a point.
One thing I like to add here, Niraj, that because we're talking about triggers and caution points, be it large cap or any, I think whenever there is a new fund in the market, what happens is that we all sort of are subject to listening to what is being told to us with respect to that particular category.
Sure.
And I think we are more influenced then. So in amongst triggers, I think it is so crucial for investors themselves to check, why are they investing? I mean, are they themselves subject to something like a framing bias, where they think that there is a perfect fund which has come out there and they should invest in it, or probably flexi cap is a category that I've missed out on. So even for the existing categories or funds, or a new category or funds, I think it is so crucial. Every scheme or a category, I think, can play a role. Every category can play a role, but I think it is very important that you don't just go and pick anything, and the right place in the portfolio, I think, can do justice to both sides then.
Got it. Okay. So that's one. The three people now, viewers, on the last two episodes who said that instead of large cap funds or whatever, flexi caps can be a replacement for large cap funds. So if you truly want a flexi cap or mid cap and a small cap portfolio, maybe multi caps could be an option there. But anyways, that's a conversation for another day. Today, now let's just quickly focus on the other aspect that we want to talk about, which is, of course, triggers and red flags on the debt side too. Mohit, can I start with you on that? Are there some differences out there?
Oh yeah, I think to my mind, honestly, the triggers for the debt are quite different from what you observe in equities per se. That is a much more complicated category, Niraj, and I think the first and the foremost part out there when I invest in a debt fund is not whether I'll get 50 bips more or 50 bips less, but I think safety of my capital is the first principle when investing in debt, right? So the change in credit quality of a fund, to my mind, is one of the biggest triggers in a debt fund. If I'm investing in a complete AAA portfolio, I don't want that to be diluted under any circumstances, right? So there are fund houses, there are fund managers whom I know will always follow a full AAA portfolio, basically. And that's where I'm comfortable with. And suddenly, if you see a rise in AA, single A papers going beyond 10% of the overall portfolio, to my mind, that's the biggest trigger. And the first alarm bell should ring out there. Every month when the portfolios are out, one should have a portfolio check. And if you see the exposure has increased in low quality credits, one has to take press the red bell out there. So that, to my mind, is the first point. Second, obviously, is in a situation of a credit event. Again, it flows down from the first point itself. But if you see papers being downgraded consistently in a portfolio, let's say if you see Vodafone kind of events where AGR dues, you find a ruling coming out of the court, or you find a THFL or an ILNFS kind of an event where papers are getting downgraded consistently in a particular portfolio, then you might just want to cut your losses out of it and just exit the portfolio before any big credit event happens. Even if a credit event has taken place, let's say, and you know that the portfolio will get segregated now, so you know that your whatever loss has been segregated out, it might not be a bad call actually to take an exit if you see the portfolio has produced one kind of a credit event. Basically, that has to be a calculated call, of course, on the overall portfolio. But yes, I think one can consider that. The third point again emanates out of the attributes of a portfolio, which is change in duration of the portfolio. Now, again, debt being interest rate sensitive, if I've invested in a short end of the curve, which is if I'm investing in ultra short term funds or low duration funds, or let's say whatever money market funds, I don't want my duration to go beyond 2 years or 1 year or that kind. I have a mental threshold to that, right? And I don't want to take any interest rate risk in my portfolio. But if I see a fund manager suddenly acting like a dynamic fund manager or a bond fund manager, dynamic bond manager, let's say in a medium term fund trying to go 10-year duration, and those kind of triggers are very high alarm bells for me. And at that point in time, one needs to take a quick call on the portfolio in terms of what kind of risk one wants to assume. And one last point on the debt side, to me, is sudden drop in AUM. Look, it's not that much of a AUM rise or fall can still be accommodated in equity, but in debt, if you see a sudden fall in AUM, debt is mostly insti money, which means a lot of insti people have pulled out, and they must, or they could perhaps be privy to more information than what retail investors are. And if an AUM suddenly drops to a large extent in a debt fund, that's a very big red trigger for us, basically. And I think at that point in time, it's good to quickly take an exit.
Mohit, a very marquee and a renowned debt fund manager in a marquee large fund house has, for reasons beyond his control, seen fair degree of drops in the AUMs recently. Could that, I mean, has that been a red flag of sorts for you?
Look, Niraj, as I told you, to us, it's a very big red flag. because there is something which is going amiss, which we might not be privy to, and insti investors typically have more information on these things. I'm not saying they know something what is happening inside the fund, but yes, because most of the debt dealers or bank treasuries or larger treasuries, they keep a very close eye on the corporates.
Sure.
So they know what kind of profile of corporates might miss payments or might go down or are facing troubles in their credit or things like that, and they would be prompt enough to take an exit. And if it pulls down the EM of the overall fund, then yes, it's a big trigger point, and retail investors should avoid these kind of zones.
Okay. Prableen, what are your thoughts on that?
So triggers, I think Niraj, Mohit is broadly covered. As a retail investor, I think something that they need to check before investing in debt, which can be, I think, which is very crucial, is the YTM. Because if a YTM of the fund, yield to maturity of a particular scheme, is exceptionally higher as compared to its peers and what the benchmark rates in the economy are, that means it's either taking a higher credit risk or there is higher interest rate risk. So I think that is something for investors to watch out for while investing, that you have to see the YTM and there has to be a justification. So they'll either say that the duration of the fund, if we see in today's times, so it would be the longer duration funds which are giving you a good YTM, or it'll be the ones which have lower credit rated papers. Yeah, I think in yesterday's or day before's newspaper, the cover page was 12.5% corporate some bond. And yeah, so see, when interest rates are, your FDs are at 5, struggling at 5%, 6%, why should somebody give you 12.5%? There has to be a reason behind it. And I think this is for any investment product which is offering you exceptionally higher returns, especially saying that it's a fixed income product. Because I think 12.5 is more than what I would even say for equities. We take 11 sort of percent sort of calculations even when we talk about equities. So I think this should be a big red flag and something for investors to be sure about when they're entering, because they are probably taking one or the other kind of risk. And I think that is something they should understand. Second, Niraj, I think one thing is the concentration risk. So sometimes, a lot of papers of a particular, let's say, sector are there. So let's say infrastructure is heavily present, or a particular sector, I think, has higher weightage. I think that should also be avoided. But of course, I mean, honestly speaking, as a retail investor, when you're doing your day job, it is very hard to go and check now what is going to be the sector allocation. So I think these are jobs for their advisor probably to actually do. And I think other than this, Mohit has covered it. And very important thing for investors not to be disappointed in debt investments is to be sure about their own investment horizon and then match the right fund to it, so that the returns that they are entering, the YTM they are entering it with, they are able to actually get those sort of returns for themselves.
Yeah, makes complete sense. Okay, we are completely out of time on the show, but Mohit, can I quickly ask you in less than 60 seconds, if you can, just a brief mention about a new regulation that people will have to keep in mind starting investing from 1st August?
Yes. So SEBI has come out with this new regulation around nomination. Every new folio which gets created now will have to mandatorily either opt in or opt out of nomination, and that opting in or opting out will have to be through a form, basically. So investor's form, a physical form, will have to be submitted along with his purchase order. Even if he's transacting on a digital platform, that physical form will be filled digitally and will be e-signed by the investor. And if it's in a physical form, the physical form will have to be submitted on nomination with a wet signature of the client. So if I, as an investor, tomorrow invest into a new fund, completely new fund, which will create a new folio for me, basically, I will have to either opt in of the investment of the nomination and provide PAN card and the PAN numbers of my new nominee, or I will have to say that I don't want to nominate anyone. And in either case, I will have to submit a form. Even opting out is now compulsorily through a form with wet signatures, is the new regulation effective 1st of August.
So effectively, any new SIP that the investor wants to do, she will have to do a wet signature, you're saying?
If it creates a new folio for her, Yes, but if it is an existing folio and in that folio, if the nomination is maintained, the remediation of the old folios, the cutoff date is till 2023, 1st of April. So you still have 1 year for the old remediation to be done, but any new folio will have to mandatorily submit this.
Get ready for more signatures, people, because the mutual fund investing ain't stopping. Prableen, Mohit, thank you so much for joining in today and giving us your thoughts. Much appreciate your time.
Thank you
so
so much. Niraj.
Thanks.
The pleasure was ours. And viewers, thanks for tuning into this leg of the Mutual Fund Show.